I would like to introduce our quarterly webinar series with subject matter expert from GrowthHive. I'm Francois. I'm the CEO of the company here, and I'd like to welcome you to this first webinar. Today, we're going to talk a lot about the economic outlook and the challenging environment out there and disruption. Before introducing our speaker, I'd like to talk a little bit about logistics for today. You'll see you have a Q&A button in your ribbon for Zoom. If you wouldn't mind typing your question there, we have a moderator that will manage a Q&A session in the last 15 minutes. Don't worry, if we can't get to everyone, we'll take your questions and answer them offline, and then we'll send you a copy of the presentation with the notes and the questions and the answers. Without further ado, talking a little bit about GrowthHive. It's a company we founded about 4 years ago to make marketing count. We are working with about 80 industrial companies around the world, from Australia to Sweden to all corners of the US, helping developing plans, messaging, and the conversion tools. So this is who we are, and then what we're trying to do here is every quarter presenting someone from the outside world with a particular topic subject matter expertise. So without further ado, I'd like to welcome Cliff. Cliff Waldman is the founder and CEO of New World Economics, is a member of the board of the National Economists Club, and this is where I met him the first time, when I was at Capital and attending the MAPI convention. He was the chief economist at that time for MAPI, and I was very impressed with the work he did. We remained friends, and Cliff volunteered to be here today, and I really want to thank him for that. He's published a lot of papers. He's hosting a radio program out there. I think you guys are gonna find him extremely interesting. So welcome, Cliff, and the floor is yours.
Thank you, Francois. Thank you for the invitation to GrowthHive. What a strange time. I mean, in many ways, risk defines our business life. It defines our life here on Earth. But we have a tapestry and a wide accumulation that is developed into a tapestry of crises, the likes of which the global economy has not seen in certainly a generation, and arguably long past that. I'm going to try to help you to think about it today. I don't have all the answers, but we have a complexity out there, which I think requires a little bit of a time for being pensive, for thinking about how everything relates to everything else and what you should think about as you're conducting your businesses, making your decisions, taking your risks in an environment that is completely unique to almost all of our lifetimes. Next slide, please. Let's take the 30,000-foot view of what's happening to us. This has been an historic period of shocks going back to 2019, a trade war that began the supply chain disruptions that we're dealing with, a once-a-century pandemic, an accumulation of supply chain disruptions that have made certainly the lives of manufacturers miserable and the lives of those who consume goods miserable, labor market disruptions that have arisen in part from the pandemic and apart from other things that are creating a very different relationship between employers and workers. The worst inflation surge in more than 4 decades. Many people in the business world today have not seen an inflation like we are experiencing right now. And as if all of this weren't enough, a disastrous war in Ukraine, an inhumane catastrophe in Ukraine that is having dangerous global reverberations and is creating risks on many more fronts that I think people even realize. Next slide, please. Let's back up a little bit. Let's go back to 2012, sort of the period when the financial crisis got behind us, and between 2012 and the pandemic in 2020, we were seeing moderate growth in both US GDP, in both the US economy and in US manufacturing. The US manufacturing, sort of fully recovered from the financial crisis in the middle of 2011. US manufacturing never fully regained its output from the financial crisis. And then, of course, in 2020, we got hit with a disastrous pandemic, and we had to shut the economy down artificially to prevent the spread of at least try to quell the spread of a deadly virus. Next slide, please. In understanding what's happening to us, you have to really conceptualize the fact that while I'm giving you lists of things, lists of prices, lists of things, you have to really understand that these are intersecting dynamics. They're different items, but they touch each other. Labor markets are affecting supply chains. So labor markets and supply chains are affecting inflation. War is exacerbating the problems of supply chains, global growth, and inflation because it's creating scarcities in such critical goods as energy and food. Ukraine and Russia are major exporters of wheat. Food prices have been troubled by the inflation, which were caused by supply chain disruptions, which were exacerbated by labor markets. And we have a tapestry of risks with feedback effects that is a tapestry of risk with feedback effects that is making everything all the more complex. Next slide, please. Let's take a look at labor markets. Labor markets are a concern for manufacturers for a very long time, and now they have become all the more volatile, all the more difficult. This graph of the U.S. unemployment rate going back to 1990 shows, the tremendous volatility. If nothing else, shows the tremendous volatility caused by the pandemic, a soaring unemployment rate and then a crashing unemployment rate. Back to where it was. Next slide, please. And in terms of just jobs, total non-farm payroll employment, a strong recovery has taken us close to the pre-pandemic level of jobs. Now, be aware of something. That's only taking us back to the pre-pandemic level of jobs in an accounting sense, to where we were. It doesn't account for the natural growth in job creation that we should have seen in the 2+ years of the pandemic. Next slide, please. But with all of that, with the very impressive job growth that we've seen in recovering from the 22 million jobs that we lost in March and April of 2020, we are still not meeting the needs of employers. This is job openings, and it is surged beyond anything we've seen in recorded history. So the job growth has been nice, but it has not met the needs of job openings. What's going on? That's just the broad economy. Let's take a look at that in manufacturing. Well, manufacturing, yeah, it's come down a little bit. It's not quite as high, but manufacturing, as it has for a very long time, as I hear from manufacturing executives for a very long time, is struggling with labor market shortages. Next slide, please. This is a graph of small manufacturers, and it is the percent who say that they have few or no qualified applicants. We at New World Economics, we have a report on small manufacturer economic activity, and we show slides like this, and the percent was saying that there are few or no qualified applicants for my job openings is at the highest since 2000. That's a remarkable thing. Next slide, please. All right, so labor market pressures are certainly an ongoing vestige of the very difficult pandemic, but they had their roots probably, a lot of this was probably ready to pop even before the virus hit us. All right, let's now go into our price pressure challenge. Oil prices have created stress at the pump. We see this. Anybody who drives know that they are, giving up their vacation in some ways to fill their gas tank up. Next slide, please. Input shortages along the supply chain are creating commodity price spikes. This is the producer price index for all commodities. It's a good measure of the price of the prices of broad commodities along the supply chain, and you can see unsurprisingly it's spiking. It's in many ways it's one of the best measures of the tightness of basic commodities, at least in the early parts of the supply chain. Next slide, please. And all of this has conspired to give us the largest inflation spike, the largest consumer inflation spike in the United States in 4 decades. But it's important to understand, next slide, please. And it's very important to actually understand that inflation is not, at the moment, is not just a US problem. It is not just a US problem. Germany is an example of another major Western country that has seen an inflation spike. The Eurozone as a whole is seeing it. Canada and the UK are also seeing multi-decade highs in inflation. So it is a global problem, at least a Western world problem, and that shouldn't be surprising to anybody, because if one of the roots of this inflation is gummed up and difficult problems with supply chains, we know supply chains are global entities. So everybody to some extent is suffering from that, and at least most of the Western world are seeing very, very difficult inflation problems. Next slide, please. Now, in the United States, to make things worse, a tight labor market as well as inflation pressures are producing a compensation surge. You want me to take this job with you? If you want me to stay with you, I mean, all of a sudden my groceries and my, filling up my gas tank is, 20, 30% more expensive. I'd like to stay here. I'd like to take the job with you, but I need more money. And that simple notion is showing up in compensation. And the fear of a wage price spiral, wages exacerbating prices, prices exacerbating wages, similar to what we had in the 1970s, is one thing that is causing the Federal Reserve to get more and more aggressive sounding with monetary policy, more and more of a tendency to say we're going to be very hawkish. We are going to raise interest rates and stomp this inflation out. Next slide, please. Now, markets have been staying ahead of this new round of tightening. This is the yield on 10-year constant maturities, 10-year bonds, and it has been going up. And as you would expect, hitting almost 3% for the first time in quite a number of years. It's an anticipation of what we know the Federal Reserve is going to do. Next slide, please. But a little perspective here, a little historical perspective, even as we go through this period of rising interest rates, bond yields, and this is, the 10-year is a good bellwether for the entire, spectrum of fixed income securities. Bond yields have been falling since the 1980s. We have been through a very long period of bond yields really falling. So even with the big turnaround that we've seen yet, we're not really entering a new era of higher interest rates. I think we will, but it's going to take some time to for that to happen. And it suggests to me that interest rates may have to go higher than people are even thinking that right now. And I get that's not a pleasant thought, but just look at the tail end of this graph. That's what's happened to us now, but it's after decades of falling bond yields. Next slide, please. Now, right here, this is why I am particularly worried about manufacturing, and why I am predicting that there is a significant risk of a downturn in manufacturing growth, U.S. manufacturing growth during the second half of this year. We have rising interest rates, we have great global uncertainty, and that's putting an unwelcome upward pressure on the dollar. Whenever there's a global crisis, and we have a list of global crises right now, investors tend to put their money in the dollar, generally speaking, relative to other currencies. We're kind of the port in the storm. We have, partially because we have the steadiest, most dependable, most liquid financial markets. When you're unsure of what's happening in the world, when the world is shaking like it is now, you tend to put your money into the dollar. And along with the fact that rising interest rates means that the return on, our fixed income securities is going up. So that's putting upward pressure on the dollar. Next slide, please. But it's putting upward pressure on the dollar at a time when the global economy is slowing. Now, upward pressure on the dollar is not good for U.S. manufacturing. About 65% of U.S. manufacturing output is sold outside of the U.S. So a higher dollar means you're at a price competitive disadvantage. It means, it would take more yen, euros, pesos to buy goods, to buy goods in dollars produced in the United States. So no matter how good you are with lowering your costs, keeping your prices low, that rising dollar means that you're all of a sudden kills your price competitiveness in overseas markets. You add to that the fact that the economy, the global economy is predicted to slow, and this is our IMF data and IMF forecast, and you can see in 2022, less than 4% growth from the global economy, really slowing from 2021. It means weak demand, for U.S.-made goods overseas, and a price competitiveness problem caused by a rising dollar, and the dollar, I think, is going to continue to rise. That is not a good set of circumstances for U.S. manufacturers, who again sell about 65% of their output in non-U.S. markets. Next slide, please. Let's take a look at a few parts of the world. European growth is really also predicted to slow. The red bars are the forecast from the IMF. You know what? It's stressed by the war in Ukraine. It's stressed by oil. It's stressed by energy, and the energy situation gets more dangerous all the time. We hear Russia cutting off, natural gas supplies to Poland and Bulgaria, and the more stuff that happens, the more European growth and inflation is going to be stressed. Next slide, please. Now let's talk about China. Obviously, China is the other mess here, and we're seeing these horrendous lockdowns because of COVID. It's important to take the longer term view of what's going on in China. Well before COVID, and really since the financial crisis, China has been in a long-term economic slowdown. And that is for a few reasons, one of which is demographics. And I've published and I've written on this. This is an aging population. It's a population that is aging more rapidly than you would normally see in a developing country. And that is slowing its labor force growth. And that's slowing, its potential growth, its structural growth. And also, it's the property sector in China has gotten overbloated, and it's starting. I don't know that that we're headed for a financial type crisis. This is a country with a very high personal savings rate, but we are certainly seeing a consolidation in the property market. So that and demographics are causing just a dramatic slowing in Chinese economic growth. And then you add COVID, and then particularly this horrible lockdowns we're seeing in not just Shanghai, but other major centers in China. And China is a negative for global growth. And that, I don't have to tell you, that matters a lot for a lot of manufacturing supply chains. Next slide, please. And the Russian economy, I thought I would put it here. This is what the IMF is predicting for 2022. More than an 8% decline, and I'll tell you what, it could be worse than that. I would bet that in a month they're going to revise that downward. The Russian economy, now it's a big, it's a big place. It's going to have reverberations. You worry about a debt default in Russia. There is all kinds of risks that are emanating from the horrendous war in Ukraine, for growth that are going to affect the growth of the global economy, that would affect inflation, that would affect financial stability. Everything is being put at risk, and everything that is a risk is being made worse by the Russia's invasion of Ukraine. Next slide, please. Now, coming back to the US, we have a flattening yield curve. And that makes me wonder, should we worry about a US recession? Perhaps some of you may not know. Let's talk for a second about the yield curve. We have in the treasury market, it could be corporate bonds too, but let's just, for the sake of simplicity, talk about the treasury market. We have yields of different maturities, 30 days, 2 years, 10 years, 30 years. But there's also a 5-year. Normally, the interest rate on longer dated bonds is higher than on shorter dated bonds. So if you buy a 10-year bond, you should normally get a higher yield than if you buy a 2-year bond. And for a very simple reason, because investors demand a higher return when they take a higher risk. And lending money to an entity for 10 years is riskier than lending it for 2 years. More things can go wrong in 10 years. So normally there's what's called an upward sloping yield curve with higher maturity bonds having a higher interest rate. Sometimes that inverts. Now, the inversion of the yield curve has generally been a pretty good leading indicator of recessions in the US. Now, the thing is, though, it's a widely varying time periods. Sometimes it predicts a recession 3 months from now. Sometimes it predicts a recession 2 years from now. But at the very least, when you get down, this is the 10-year treasury minus the 2-year treasury, you hit that zero line and go a little below it. That's an inversion. Going slightly, inverting for a couple of days and turning around is not, is not an indicator of an imminent recession, but it does create a worry. It does make you worry about it. And interestingly, this is a good segue to the fact that the first quarter GDP number for the United States came out this morning, and it was negative. Now, it was negative for what are probably a lot of one-off reasons. We had a huge inventory swing, and with no surprise, inventories took inventory restocking was a negative for GDP. It took up more than 3 percentage points in GDP, I believe. COVID has created a lot of volatility, and the trade balance, the widening trade balance. I will tell you, but as a lot of forecasters were commenting on social media, on the wires this morning, that we did nonetheless have growth in consumer spending, growth in business spending. Yes, that's true. So I wouldn't take a negative GDP print this morning as being an indicator of a recession either, although I'm a little more worried about it than a lot of other economists seem to be. I thought that the consumer spending complex was, yes, it was 2.7%, but almost entirely due to services spending. Goods spending, and particularly non-durable goods spending, actually fell off. So yes, it held up, but there was some weak parts of consumer spending. Now, in business spending, equipment spending was strong at 15%, but yet a negative in structure. So I thought that, the consumer spending and business spending, yes, positive, yes, takes away from the bite of a negative GDP print from one-off factors. But nonetheless, there was a little bit of slippage in the full complex of those spending areas. You put that together with a yield curve that's not fully inverting, but is going in the wrong direction historically. And I'm going to be watching, for signals of a U.S. recession. The Fed has a big job to do. It's indicating it's going to get faster and faster and harder on raising interest rates. I reported on Chair Powell's speech to the National Association for Business Economics back in March for my radio show, and I was in the room when he spoke, and he's a very sort of demure, very muted person, but he had an aggressive look on his face. He knows that he's got a big hill to climb with this terrible inflation, which has gotten out of control. It's the biggest risk we have. Next slide, please. All right, so let's sort of put it all together. We're not going to answer every question. Let's review what we're dealing here with. As I said, it's important to understand the relationship between all of these this list of crises and problems. The trade war, the pandemic, and underinvestment in critical inputs, such as semiconductors. Semiconductors were a fault of ours that we started years ago. This country underinvested in semiconductor capacity, and it wasn't a smart thing to do, and it showed up right now. But the trade war, the pandemic, and underinvestment in critical inputs have generated wide supply chain problems. Supply chain dislocations, labor market shortages, and a Fed which has frankly got behind the curve have conspired to contribute to the worst inflation spike since the early 1980s. The early 1980s. That newly hawkish Fed, shown very well in Chair Powell's face when I sat in on the lunch with him, is creating a recession risk. There is no question that there is a non-trivial risk of a recession in the United States. And Russia's invasion of Ukraine is aggravating all this. It's aggravating the global inflation problem, but is also creating a global growth risk. Next slide, please. All right, so what are my conclusions? What are my conclusions about the short term for now? Well, I see that supply chain instability and inflation instability will be with us for much of 2022. We're not going to get rid of either of those problems for the balance of this calendar year. I think there's a non-trivial risk of a U.S. recession, at least by the end of 2022. I'll put it at 40%. If you want a number, I'll tell you, I think it's about a 40% risk of recession. That's uncomfortably high. The war in Ukraine and the potential downstream impacts of the sanctions on Russia are leading to the risk of a significant global slowdown, and we're starting to see data that are supporting that. So one more slide here. And this is an important thing. We'll get past this period of very significant risk, volatility, complexity, frustration. But it's going to leave marks. It's going to lead to changes in the years to come. Let's talk about the years to come. And what do I see as the big changes, as the legacy of this most unusual period in history? Well, first of all, defense spending. Defense spending is going to be on a Cold War posture. And that is going to have significant impacts for parts of manufacturing. I'll be doing work on this and giving talks on this, but defense spending is going to get back to a kind of a Cold War posture with big implications for manufacturing. You're probably going to have some kind of supply chain realignment. There's a question about whether supply chains are going to go from global to regional. I don't think entirely. There's too many benefits to global supply chains, but I think you're going to have certain realignments in the supply chain that are going to be non-interesting. Clearly, we're going to a period of higher interest rates. That's an easy one. The slowdown in China is not just for the near term. It's going to continue in the years to come. China's growth is slowing and will continue to slow for a lot of very powerful structural reasons. If nothing else, its aging problem is going, and its aging challenge is going to slow China down. The fear about China, as many analysts have said, is it grow old before it grows rich. And that remains a concern. Also, we're going to see, and I don't think I have to convince a lot of you of this, that a dramatically changed relationship between employers and the workforce. It's not just work from home. Certainly work from home is one thing, but also the hours, the use of hours, the way people are paid, whether people are full-time, you used to have full-time employees and outside consultants, but I think you're probably going to see more classifications of labor input than we have seen before. That one's in flux. That one will continue even when the pandemic is just a very bad memory. And speaking of which, I think COVID's going to remain a significant global challenge. We see that in China. Who knows what's going to happen in Africa, whether or not we're even getting correct data on that. But in the US, it's a smaller challenge. We are probably, as Dr. Fauci said, out of the pandemic phase of it, but it's going to be a persistent risk. I don't think it's going to necessarily totally go away, but we have to follow that one. So that's where I am at with all this. This longer term view is probably the most important for your thinking past these years, but we have a tapestry of risks that are intersecting with each other, and that a U.S. recession bears watching as a big risk, and I think there's a non-trivial risk of a downturn in U.S. manufacturing growth sometime in the second half of this year. And that's it for me. Thank you.
Thank you, Cliff. I was muted. Thank you, Cliff, for this wonderful overview in 30 minutes of the global economics. It's pretty amazing to me. We're going to enter the Q&A session. So everybody, if you can, just go on the Q&A and ask your questions. And Amanda's going to take us through that in a minute. So whilst we're doing this, these are the contacts for Cliff. Don't hesitate to reach out to him. Is available to consult, to help you guys figuring out what's going on. The crystal ball is immense there. Call him, email him, and we'll visit his website. Cliff, my question is, I'm going to try to recap some of the points you made, and hopefully I'm not going to be too far out. Quite the big dependency on exports in the US economy. I think you said something over 60%.
In U.S. manufacturing, not the U.S. economy, U.S. manufacturing. Yes.
U.S. manufacturing.
Correct.
Yes. High interest rate, difficulty to kind of finance growth and stuff like that. So that could hamper the ability to get funding. Also, we're seeing the high value of the dollar in the outside world, which makes our pricing curve defavorable.
Right.
Would some of it be offsetted by the resurgence of certain markets in the US from a manufacturing perspective? I'm thinking about oil and gas that was a bit behind. You mentioned defense, and aerospace is my kind of, medical will be about weather, in my opinion. Right. I'd just like to have your opinion on that, because many of our clients that listening today and will listen on the replay, I'd like to have and I think Emily's also asking kind of similar question here, Amanda and Emily. So do you have any kind of perspective on where to edge your bets?
Well, you have to realize the answer to the question is time, a time sink. What I've been talking now largely, except for that last slide, largely are the crises that are rocking manufacturing, rocking the outlook generally. And higher interest rates, you can make it even simpler than that. It's going to all likelihood slow the U.S. economy. If there's a definite risk, it's going to slow it into a recession. And manufacturing tends to follow the U.S. economy. If the U.S. economy goes into a recession, that tends to pull manufacturing down too. So all this is short term, rocking and pain right now. What you're talking about are the foundational investments for well beyond the period of a year or two that I'm talking about. What it's going to look like 5 years from now, what it's going to look like 10 years from now. So all those things that are catching up with energy, R&D and medical things, biopharma is going to, I think, explode for obvious reasons, and that'll have big favorable effects for manufacturing. Defense is, for a very unfortunate reason where defense spending is going to increase, but it will have potentially strong impacts on manufacturing. But it's time, right? What I'm talking about now is the rocking boat that we're all in for the next year or 2 years or something like that. You're talking about the boat being strong for future cruising. So yes, I absolutely agree with you. But our only difference is time. I'm talking about a year or two. You're talking about things that are going to matter a decade from now, 5 years, 10 years from now. So that, yes, I agree. But it's a difference of a year or two versus 10 years.
Well, some of us will be retired in less than that. Hopefully. No, seriously, going back to seriousness before I leave the floor to Amanda. When I used to work in corporate, we had this 6 months, lag time. Purchasing Manufacturing Index, I think PMI,
Yes.
was a bellwether. Any idea where that stands right now? Still
Well, the
above 50?
Purchasing Managers Index is it's the oldest survey indicator from the Institute for Supply Management. It's the oldest survey indicator in the United States, goes back to 1931. It is a good indicator of where manufacturing is going very short term, the next 2 or 3 years. In past months, past 6, 8 months, every report has been consistently the same. We have red hot demand for manufactured goods. I mean, some of the demand indicators from the ISM survey have been at generational highs. The problem is supply chain problems have also been at generational highs. We are getting demand like we've never seen before. They're having a terrible time making it. So it's a very good news, very bad news story. And that's what the ISM number has been showing.
And okay, I don't remember if we saw those slides in there. I think we may, but I'll get back to you. So Amanda, floor is yours. Maybe you can take some of the questions from the audience.
Yeah, absolutely. Thanks everyone for your questions. We have a couple here that we can go through while we have time. One that has come up from a couple of people in a couple of different ways is, do you have sort of best risk mitigation strategies that manufacturing companies might use to weather this time? Yeah,
well, that again, not my area of expertise. I'm not a risk manager in any way. I would say, well, first of all, the best thing you can do is to pay careful attention to what's going on. And what I would pay, and I've had this conversation before with manufacturers, pay careful attention to what policymakers are doing. And these days, particularly central banks, and particularly the Federal Reserve. Listen to what's happening, see what they say they're going to do. That's going to matter. Listen to a range of analysts and economists. And while I would be a little careful with risky investments now, I don't think I would pull the antenna in too much. But the problem with answering a question like that is it often depends on the industry. So that's really I can say. But my sincere advice to everybody is to keep your eyes on all this and pay attention to what policy people are going to do, what the Fed and other central banks are going to do, what is being done, the progress of the war in Ukraine. Pay attention to global markets. Look at the dollar, look at commodities prices. They're telling you look at interest rates. They're telling you a lot of things.
Great, thank you. Another question that we have is, will the anticipated decline in US manufacturing offer growth opportunities for China due to the cost of the dollar, or is it anticipated that the growth in China will continue to decline as well? The main concern being that import products will dominate domestic product growth and manufacturing over time.
Yeah, but they're not necessarily, inverses. I mean, actually, the U.S. economy does not. The U.S. manufacturing depends a lot on exports. U.S. economy far less so. And China right now is really having a lot of internal problems that are and internal, not just problems, but internal challenges. So I don't necessarily see China as being, that if U.S. manufacturing does go into a downturn through all this mess, that that China's manufacturing is going to pick up the slack. I don't see that. They have been slowing for some time now, even before the pandemic. This crazy lockdown story is making things all the worse. So I think the Chinese, at least for the foreseeable future, the Chinese economy and thus Chinese manufacturing are not a place to hedge anybody's bets right now. They, I would not say that, bad news for U.S. manufacturing is offset by good news for Chinese manufacturing. Not at all. I think they're both at risk from a tapestry of problems here that are not going to go away very fast.
Francois, you're muted there.
Yeah, I know. I was trying to unmute myself. One of the things that, from manufacturing's perspective, the export are very strong also to China. Aerospace in particular is extremely strong to China because of Boeing and the supply chain associated with it. So these are things I remember from my old days, and I've been quite following up on them as well. So I agree with you, Cliff, on that. It's a mixed thing. All right, Amanda, one more question, maybe?
Yeah, I think we have time for at least one more. So one that we have in here is, over the next 2 years, will the value of the US dollar have a positive impact to businesses that are importing from Europe to sell in the US manufacturing sector?
That's a good point, and I didn't want to belabor it. Yeah, I mean, obviously the rising dollar, which we are experiencing right now, is not good for price competitiveness of US made manufactured goods. What it does do, though, there's another side to the balance sheet, though, is that it makes imports less expensive in dollars, less expensive in dollars for U.S. manufacturers than anybody else who's importing. So yes, it could have and it's a very good question, because you really see at a time like this, when currencies are moving a lot in a crisis period, that the path of the US dollar and the path of the euro tend to almost look like exact opposites, just the inverses of each other. So yeah, that could be the case. Although the problem is that both sides of the Atlantic, or both sides of the pond, shall we say, are experiencing very high inflation, and that is sort of skewing. If inflation was stable and normal, I would totally agree with you, but that's skewing the picture a little bit. But yes, there is another side to that dollar story. If it keeps going up, then our imports, and particularly from Europe, we're going to get a break on that side. Although it's been shown with research that the price, the negative tends to, with a rising dollar, the negative a rising dollar, particularly in a slowing global environment like we're seeing. Unfortunately, at the risk of sounding like a party pooper, the negative tends to outweigh the positive. The loss of price competitiveness for U.S. exports in non-U.S. markets tends to outweigh the fact that we're getting a kind of a price break on imports. But it's a good question. It is a good question. So yes, in general, I agree with you.
Thank you. Francois, do we have time for one more?
Why don't we do it?
Okay. So another one that we have here is just a question about reshoring. So essentially, is reshoring a pipe dream, or is it a reasonable alternative to the status quo? If it is an alternative, about how long do we think it will take for reshoring to displace manufacturers' dependence on China and other overseas sources?
Reshoring is an interesting. I've always thought that the reshoring discussion is a bit misplaced, because what reshoring suggests, and again, I haven't dealt with the issue a great deal, not something that I've been in on a lot of discussions. So a little bit of caveat emptor, but I'm giving you an impression now. What reshoring suggests is that there's a competition where jobs over there, let's say China or Europe, means a lack of jobs over here. Like there's a constant tension. But with these wonderful global supply chain systems, which are terribly troubled right now, we're seeing that they're broken right now. But with the global supply chain systems that we've seen, it's often the opposite. Very often, with a large supply chain, but growth in Fujian, China, can have a positive growth in Canton, Ohio. Mm-hmm. So reshoring can miss, and we're going to have. Believe me, I am not giving you this with an absolute air of confidence, but with a postulate, with a hypothesis for me that we're going to study for a long time. But if you reshore, then Canton, Ohio, from China into the U.S., let's just say, then the Canton, Ohio jobs may not be, in as good a position as you think they are, because they're going to miss the energy that reverberates along the supply chain from positive activity in Fujian or Beijing or Shanghai. So the theory under reshoring suggests that, globalization creates an us versus them thing, when often it's both us and them creating benefits for each other. It's a little too, I think the world has become too complex, and many people will disagree with me, understand, but I think the world has become a little too complex to suggest that reshoring is the answer to competitive problems.
I've been there in the very beginning of offshoring, and I was kind of part of it in my first employer, and we're seeing it on the reverse now. There's a lot of jobs coming back. Specifically, you mentioned semiconductors earlier.
Right.
I think we tallied up for one of our clients a couple of weeks ago. There was like 65 or 70 billion dollars of committed investment in the US on the semiconductors, plus all the federal support that those guys get to support that activity. So I think it's time to close this. We could be here for the rest of the day. Just want to be respectful of our time. I'm just going to flashback Cliff's contact again. Cliff is really good, counsel at time, and don't hesitate to reach out to him if you have any questions. And same with us at GrowthHive. If you need some help with planning or doing some strategy or doing some marketing in a new world, we're here to help. So that being said, thank you everybody for joining, and have a grand afternoon, evening, morning, wherever you are in the world, and take care. So long. Bye.